Welcome to the Economy and Politics Show, where we discuss key political and economic developments as it affects the households. This edition, a very interesting one, will look at Nigeria's economic growth trajectory for the second half of the year 2022. My guest is Mr. Abdulqudus Isiaka, a senior economist with Proshare. Nice to have you again, Mr. Abdulqudus.
Thank you.
Always an interesting time, and we're looking forward to an interesting conversation as start of the last week of July 2022.
Absolutely.
Thank you.
Thank you for having me.
Before we have this conversation, let's give you a wrap of some key stories from last week. The Central Bank of Nigeria Monetary Policy Committee, in a unanimous decision, voted to raise the monetary policy rate from 13% to 14%. This was a 100 basis points raise, and this is the second time in the year that this is happening. According to the Central Bank of Nigeria Governor, Mr. Godwin Emefiele, this was in response to the rising tide of inflation in the country, which has eroded the purchasing power of the citizens. President Muhammadu Buhari, GCFR, unveiled the new Nigerian National Petroleum Company, which, according to him, will enable Nigeria to achieve national energy security. Also last week, the federal government announced that it has recorded a 3.09 trillion naira deficit in its 2022 budget implementation between January and April 2022, just as it projected a 6.72 trillion naira expenditure for fuel subsidy in 2023. According to the Minister of Finance, Budget and National Planning, Mrs. Zainab Ahmed, the total amount released in terms of spending for the year so far is 4.7 trillion naira to address debt servicing, which was 1.9 trillion naira, while personnel costs and pensions go up the sum of 1.2 trillion naira. In analysis, it showed that this debt servicing surpassed its revenue in first quarter of 2022. So if you're joining us, it's the Economy and Politics Show, and our conversation today is on Nigeria's economic growth trajectory, second half of the year 2022. And my guest is Mr. Abdulqudus Isiaka, senior economist with Proshare. So Mr. Abdulqudus, let's first begin with the global inflation environment. It's quite alarming, I must say, when you look at the rising tide of inflation, not just in Nigeria, but across the globe. Let's take out three major economies: the United States of America, United Kingdom, and Canada. The inflation rate for June that was released showed that the US recorded 9.1%, the UK recorded 9.4%, and Canada recorded 8%. And this is one thing I like to say that is interesting, because while Nigeria, which recorded 18.7% for June, is trying to return back to a single-digit environment in terms of inflation, the Western developed economies are now battling not to get into that double-digit environment. Now, the response we're seeing from central banks across the world is raising the rates, monetary policy rates. That seems to be the major tool in their hand. The ECB, European Central Bank, under the leadership of Christine Lagarde, for the first time in 11 years, raised rates. It shows a lot of concerns. There's still discussions that we may be heading to a recession. Fuel and food identified as the major drivers of this, and we are seeing the impacts. Sri Lanka, what happened, toppled the government because of economic issues, Panama and Ecuador protests. From your perspective, are the CBs right to just use that tool of raising rates? What are the other areas can be explored, because this is becoming a real global challenge?
The kind of inflation we had last year was one that was caused partly by a pent-up demand, under up to about $16 trillion in terms of stimulus package, led to a build-up of demand, and coincidentally, to make a perfect storm, we had supply chains buckle, and so the perspective of monetary policy authorities last year was that the challenge of inflation that we were confronted with was transitory. Essentially, they were of the view that if we waited long enough, and maybe if we pushed vaccination up enough, to about 60%, we could manage to, restore the global economic engine was likely to be restored, and we could see economic recovery in full in 2022. As a matter of fact, there was an IMF report where it was suggested that if we could make available up to $50 billion for vaccination, we would be able to see $9 trillion expansion between 2022 and 2025. But it's 2022. The realities are different. Yeah. As a matter of fact, by 24th of February, 24th of February, when Russia invaded Ukraine through Crimea and through Belarus, two countries that were now allied with Russia. As a matter of fact, Russia had annexed Crimea in 2014. Now, so and since then, Russia has shown that it is not favorably disposed to Ukraine's overt efforts to join EU and the NATO.
Atlantic Treaty Organization.
So all of that were justifications for Russia invading Ukraine in order to defend its territory. But the part of it that speaks more to your question is the fact that in the aftermath of the Russian invasion of Ukraine, we saw waves and waves of sanctions. Now we saw
we're supposed to punish Russia and bring them to that submission.
Absolutely. So we saw, first of all, US help support the Ukrainian government with $200 million in military aid, but it didn't stop at that. It went ahead to actually impose sanctions on the Russian central bank in order to shut it out of up to $600 billion of its reserves. Of course, to first of all make it difficult to be able to pay for war, and also to be able to force it to default in some of its debt obligations. Now that was there on the one hand. There was also the effort by the EU, UK, and the US, all those Western allied countries, to bring Russia back to the negotiation table and stop war by shutting its bank out of the international financial messaging system, SWIFT. So while that was also on, there was also a target on, or well, we call it a target on the oligarchs, the big businessmen that were one way or the other connected with Kremlin and the Russian government. So, and then again, we saw multinationals exit the Russian economy.
Oil and gas giants, Starbucks, various companies.
We saw Coca-Cola, we saw McDonald's and the likes, all exiting the Russian economy, so shutting down their operations in that environment. So, while this was on, Russia was still able to export oil and gas and was still able to fund its war against Ukraine. And so, in perhaps an afterthought, the U.S. economy, of course, along with other Western allied countries, considered, shutting or reducing their demand for, crude oil from Russia. So, as a matter of fact, U.S. completely stopped its demand of Russian oil. And the EU and the UK, promised to phase out their demand for Russian oil by the end of the year, and their demand for coal by August. So with all of that, we could say that, okay, the ruble took a hit, dropped by 29% by March, but then the Russian government delivered a masterstroke. We saw it instruct Gazprom. We saw it instruct Gazprom to begin to demand for payment in rubles, which was meant to shore up the ruble. Aside that, it also raised its rate, doubled its rate from about 9.5% to 20%. And so combined, those two, those two decisions combined delivered, an improvement in the ruble. And we saw it hit a 7-year high, as a matter of fact, in value. So if we consider Russia's, position in the scheme of things, we would understand why it would be absolutely impossible to have such sanctions not have a ricocheting effect or a reverberating effect on other economies. Russia supplies 26% of EU's crude oil, supplies 40% of the EU's natural gas. It's, along with Ukraine, supplies about 25.4% of the global demand or global wheat production.
That was where I was waiting for, the wheat, because that's very key.
With each sanction, we saw the market respond. We saw the market, anticipate, buckled in terms of supply. And so, the expectation was that the market would become tight at the moment. And so we saw prices, crude oil prices rose. We saw the price of wheat shoot up. and as well as other grains and even, soft commodities and even rare metals that these two countries produce. So that, really it serves as the basis. And it's really important for us to understand, the fact that the inflationary environment we're seeing is set within a peculiar context. And that's really how we're seeing inflation. Now, inflation in the US is reaching record high. In the UK, it's the same thing. In Nigeria in particular, being an emerging market, it's not different. Nigeria recorded an 18.6 inflation, headline inflation in the month of June. And that's like 300 basis up from where it was at the beginning of the year, 15.6%. And, we have a target, a single digit target of inflation where, we don't seem to be on course to achieve.
Don't seem to be on course on
now,
that.
if we consider again monthly inflation rate, which is, over the last 12 months has been about 1.4%, it does look as though the overwhelming likelihood is that we would see inflation, approach 20% by December. Also take into consideration
20%.
Headline inflation.
Headline inflation, yeah.
So we would see it, approach 20% or above 20%, slightly above 20%.
Food may even hit 22%.
Certainly.
Wow.
Except of course, if we see a bumper harvest towards the end of the year. We're seeing all of these inflationary worries. And while, Nigeria has tried to, in a way, pick up the slacks occasioned by Russia's pullback, because it indeed has pulled back, it reduced crude oil pumping by 10% and has reduced its supply of gas to the EU, the Eurozone, by 60%. And so there is that slide. Again, it threatens them overtly or covertly every now and again with the Nord Stream 1 cut off, natural gas.
Nord Stream 1 is a very big one.
So although it claims it's due to force majeure, but really and truly, we can expect that Russia will continue to do all it can, to cause disruptions in not just the economies of the EU, but also the global economy. So that just gives us an idea of, the context behind, these inflationary concerns we are seeing and how it's, significantly different from what we had last year.
Let's look at Central Bank of Nigeria, second time raising the monetary policy rate this year. And of course, like you rightly said, we may be heading, headline inflation may be heading to 20%, which is really going to continue to erode the purchasing power of citizens. That's a major concern, Abdulqudus, the purchasing power. And that is a trigger for crisis, because when purchasing power is eroded, it triggers a lot of crisis and concern. So what do you see? What's the scenario between our next MBC meeting, when it comes to this very adverse impact on inflation for Nigeria, and as it affects or erodes, let me put that word, erodes the purchasing power of citizens?
Okay, so the decision to raise monetary policy rate by 100 basis points in the last meeting that held in June was anticipated. If you look at the voting pattern in the penultimate meeting that held in May, we had 6 members vote for a 100 basis points hike, 150 basis point hike. And, it's kind of signaled a hawkish tone, and we expected that, going forward.
And this was unanimous this time, not even like there was any variation.
Yes. So last time, in the June meeting, right, all members voted for a hike in rates. Although 6 members voted for a 100 basis point hike, 1 member voted for a 150 basis point hike. So the committee went with a 100 basis point hike in rates. It was imminent. We saw it coming because, first of all, it was a voting pattern from May. And then we also saw inflation surge, over that period. So it surged to a 5-year high, 18.6%. So, it was very much expected. But, what is the CBN doing? What's the Monetary Policy Committee doing? Is it taking the best decision? Are there other alternatives? Those are really questions that I think we need to answer, really. And basically, if you look at it, we need to appreciate the fact that the CBN, and in effect, or by extension, the Monetary Policy Committee, has that responsibility of not just, price stability. The CBN Act, establishes the mandates of price stability, as well as, stimulating economic growth, managing FX rate stability, as well as, trying to regulate the banking sector. So there are a lot of factors, and that naturally creates, a situation where there's a trade-off. Every now and again, you have a situation where you have to let go of one to achieve the other. And so I think we're seeing that play out. And while, inflation may be a real concern, because of the point you made about how very quickly it erodes capital and the purchasing power of, the capital of investors and the purchasing power of households, it's also something that economists always look out for. The fact that we could have a situation where, trying to drive up rates too fast could cause a major slowdown or even a recession. In the case of the US, for example, we saw it record a 1.5 after review, a 1.6 negative real GDP growth in the first quarter. And we've seen them, consistently increase rates. And some economists have tried to chalk that up to, the rather too speedy increase in rates. But to come back to Nigeria, we're looking at a situation where, inflation is running away, and the CBN has only, limited devices at its disposal. But I think we need to decompartmentalize these inflationary challenges we have. We have inflation due to the global energy and food crisis we already talked about. And we also have inflation attributable to, logistical challenges. We're looking at we're looking at cargo clearing logistics. We're looking at transportation costs. We're looking at insecurity, corruption, multiple tax regimes, and all that. Being major factors that feed into the inflationary trend that we're seeing, right? But you see, those two contributory factors to the inflationary trend are not particularly within the purview of the CBN. It's not really able to address either of these two.
The fiscal needs to continue to impose
we'll be looking at fiscal policy and structural policies addressing those two. But the CBN is able to address the other two forms of inflationary worries. There's money supply, and there's also FX liquidity.
It's still the big issue.
But if we look at money supply, there are two things about it. Firstly, we're querying the data and we're wondering whether it's a critical determinant of inflation. Over the years, it hasn't seemed to be the case. But at any rate, the CBN has typically used the CRR debit device to mop up excess liquidity. And maybe, as has been argued by analysts, maybe it has been doing that rather atrociously. But, and perhaps that's why...
The parameter wasn't changed. It
exactly, it remained 27.5%. But, and you could argue that that's why, the CBN governor, or if you like, the Monetary Policy Committee, was a little bit reluctant initially in raising rates because they had CRR debits and they used that to mop up excess liquidity. But again, we could argue that money supply has a way of feeding into frivolous demand for FX, which creates a different vista. We'll be looking at it from a different perspective. But at any rate, it all boils down to FX. We're looking at depreciation of the naira. We're looking at FX scarcity. And so we need to, really look at that. And I would say that, if the CBN or the Monetary Policy Committee needs to be innovative in trying to address this challenge, I think that's where to focus on. Firstly, we need to take a second look at the FX restriction list. There's some items on that list that ought to be off the list. If we have critical input items that are on that list, it means that they would have to access FX at the more expensive window, which is the parallel market. Now, there's that challenge. I think the RT200 FX program.
You want them to revisit that FX restriction list for, I think, over 41 items.
Yes.
Okay.
So then again, the RT200 FX program is been, you could call it a success. They've been able to, within a short period, raise $2.4 billion compared to $900 billion last year, which is quite impressive. We're seeing an appreciation in non-oil export proceeds being remitted or repatriated. And that's the whole idea behind the FX200 program. But the argument is that analysts are wondering whether the 65 naira rebate, or depending on what part of the transaction you are, 65 naira or 35 naira rebates, is it adequate to show up the parallel premium, or if you like, the parallel gap, which is usually a motivation for exporters to make their remittances to the parallel market as against an official window, or if you like, the NEFX window. So we're still looking at a major parallel premium which needs to be closed, and that's what basically we argue for. There is a need to actually close the gap between the windows.
Let's look at what we discussed first, our first conversation for this year, the sectors of the economy that will drive goods activities in the country. We highlighted some of them: agriculture, information and communication technology. We also looked at real estate and construction. So when we look now at the second half of the year, has anything changed, or do we have additional sectors that may be the game changers?
I would say we could, glean some insights from the Q1 real GDP figures. We saw ICT post a very strong performance. Telecoms, over and above 10%, close to 12%.
Double digit. They've always been
double
driving
digit,
that.
Exactly. So telecoms came up with something between 10 and 12% real GDP growth, and they contributed over 16% to the real GDP in that quarter. So we expect that it will continue, although it's cautious optimism, because there's been this directive from the NCC to block 75 million subscribers from making calls, although they're still able to receive calls. But on the brighter note, we saw 8.9 million new subscribers over the period, which is quite impressive. And so, taken together, we could say that the telecom sector should still be able to, post a very strong performance in the second half of the year. Then we saw trade also perform well, also made a over 16% contribution to real GDP. And if you consider the fact that we're heading towards election period, so we feel that, electioneering and, things related to election surveillance would kind of support that particular sector. We feel strongly so. Then we also expect finance and insurance to respond to the higher lending rates because of the adjustments in MPR. So that should, to some reasonable extent, affect their bottom lines, and that particular sector should be, supported positively. Then we also expect manufacturing and agriculture to post impressive performances, chiefly because they will continue to be supported by the development finance interventions of the CBN.
So looking at the second half of the year, discuss around the growth. What's the growth trajectory for 2022? And interestingly, in the what to expect, I must commend Proshare. The what to expect is one very rich analysis and report that prepares the minds of analysts, economists, policymakers, and every citizen who reads on what to expect, plan, and strategize as it has to do with the economy, not just Nigeria, the sub-region, that's Africa, and of course, the globe. But let's look at 2022. What would be the likely growth figure and implication? And also, you raised something very fundamental. You questioned the plus 3.75% growth projection for 2023. That's for the Nigerian economy from the federal government. You said that, the basis for that is questionable. So I'd like to know what informed that perspective too.
Okay, I believe you're referring to the medium-term fiscal framework.
Yes, fiscal framework.
So the medium-term fiscal framework is built on, or was prepared on, two assumptions, especially with regard to the year 2023. Two scenarios. Scenario one being the business as usual scenario. Scenario two being the subsidy removal scenario. And so in the first scenario, where subsidy is retained for the whole year 2023, the expectation based on that document is that the government would expend 6.7 trillion on fuel subsidy. Now, in the event that subsidy is retained for only half of the year, you should see 3.35 trillion naira. Now, at the same time, if you look at the capital expenditure projected for that year, 2023, we expect that capital expenditure in the event that subsidy is retained would just be 1.49 trillion naira.
Yeah.
Now, if subsidy is, removed after, 6 months, right, we expect capital expenditure to increase to 2.6 trillion naira.
Yeah.
So we're looking at a difference of up to about 1.1 trillion naira that should have, so we're saying that up to 1.1 trillion naira that would have gone to capital expenditure will be being used for footing the subsidy bills. And so we're saying that we can retain growth projections, the same growth projections for both scenarios, primarily because reallocation of spending, okay, from subsidy payment or from capital expenditure to subsidy payment or vice versa should have an impact on the growth outlook. So because, of course, we know that subsidy payment is one of the most inefficient government spending because it's riddled with a lot of corruption.
Yeah.
And, we don't even know.
There's no transparency.
Absolutely. So we don't even know, how much PMS is consumed. Some argue 60 million, between 60 and 120 million is what the regulator says. Whereas analysts believe that at most we should be looking at between 20 and 25 billion. So the argument, therefore, is that if we have is 3.75% growth projection for a situation where, subsidy is removed after half of the year, then we should expect, therefore, that if subsidy is retained for the whole year, that particular scenario, we should be looking at something much less than that. But at any rate, the medium-term fiscal framework reviewed the 2022 growth projections, and it reviewed it downward in the face of, the inflationary worries and the expectation that consumer spending would have been reallocated to non-essential, to more essential and away from non-essential items. So it reduced growth projections from 4.2% to 3.55%.
Yeah.
But Proshare, I believe that's also still overly ambitious. We think that, we should be looking at something in the range of 3% for this year.
3% for this year. And then in wrapping up in just less than a minute, we are facing a fiscal challenge. Our debt servicing surpassed our revenue. What's the way forward in addressing this? Because it's very critical. Abdulqudus, as you look at, you've said it, we are heading to an election year.
Yeah.
We're facing challenges. We talked about the issues of inflation, fuel, food being the big drivers. What's the way forward for this government?
The Nigerian economy is, especially the fiscal space, is within what you could call a fiscal cliff. So it's on a fiscal cliff. And that's not least because we are seeing revenue between the period January to April. We're seeing revenue underperform. Revenue performance was about 49%. We saw expenditure perform 82%. We had a budget deficit of 3.09 trillion. What that means is that if we had a 100% performance of expenditure, the budget deficit would have been much larger than that. That's one. Number two is that we saw debt service. We saw a debt service cost overrun of about 47%, right? So we spent over 600 billion more than what was budgeted for that period, reflecting global, hike in interest rates. We also noted the fact that debt service to revenue ratio, was closer to 120%. It's inched closer to 120%. Now, this time last year, we had something in the range of 97 to 98%.
Yeah. And,
it was almost a pandemonium, but nobody knew things would get much worse. So we're looking at 120% debt service to revenue ratio. I mean, that signals a big fiscal challenge.
That's a big fiscal challenge.
And I think in addressing it, there are a number of low-hanging fruits. First of all, we need to look at crude oil theft and vandalism. So Nigeria loses between 200 and 500,000 barrels a day. That's massive. A lot of funds that would have been available to prosecute budgetary operations, get lost to vandals and other thieves. So that's one. We need to take a second look at the SRGI. Now, the Ministry of Finance, Budget and National Plan in 2020 introduced the Strategic Revenue Growth Initiative. And that particular initiative set a target of 15%. Yes, 15% revenue to GDP of 15% by 2023. Now,
is that still feasible?
It's not feasible, and that's the point I was coming to. Okay. If you look at the growth projects and the MTFF, the Medium-Term Fiscal Framework, the revenue projection for 2023 is about 8.49 trillion. Now, that's nowhere near 15% of our GDP. And so that it tells a tale, and it calls for action. There's a need to take a second look at the SRGI.
You have to review the SRGI.
The SRGI needs to be reviewed. That's number two. Number three, and perhaps most critically, we need to look at our debt strategies. There's a need to, rejig it. Currently, what we have is we're issuing, debt against, or IOUs, promissory notes, against revenues that's not coming. So crude oil over the period January to April.
When you issue IOUs for something that's not sure.
Absolutely. So if you are, we're issuing IOUs and promissory notes for revenue that's not coming in, crude oil revenue underperformed. We only had a 39% performance of crude oil revenue. And that's massive. And it's definitely going to affect our issuer default ratings. So we need to begin to look at asset-based debt strategies. We should look at how to unlock revenue from all our assets, idle assets, with these enormous idle public assets around the country. And this can be securitized in order to obtain loans. And we will use our assets as against expected revenue. That's one. Number two, we should consider actually issuing licenses for greenfield investments. The telecom sector was unlocked, the opportunities and the potentials of that sector was unlocked just by licenses. And I think we should consider that in many other sectors. Then finally, we should look at offering equity in special purpose, predominantly government-owned companies. Like something NNPC, similar to what we are doing with the NNPC and what we've been doing with the NLNG. We can consider that
the government can even take part of its stake in NLNG and list on the market and all that.
Absolutely. So by doing that, you're not only discovering price discovery by and also valuation for the purpose of valuing these companies, but you're also going to be able to earn quick revenue from that and be able to prosecute your fiscal operations by that. So essentially, I think we can consider this, but it's a turbulent time, really.
It's a turbulent time, Qudus. Proshare has been speaking about this over the years, right from the session of this administration. Other economists and analysts have raised these fundamental issues. Now that we are in the cliff, I think it's time to hit the bullet, take this option, and rescue the economy, because we don't want to be in a crisis situation, as we see in some other economies. Thank you very much, Mr. Abdulqudus, Isiaka, Senior Economist, Proshare, for this very interesting conversation. So much to learn. And again, very instructive steps that has to be taken for our economy to experience some level of stability. We'll still bring you on board again to look at the economy as the year wraps up, because there's a lot to learn. Thank you very much.
Thank you for having me.
That will be all for this edition of Economy and Politics Show. If you have views, comments, suggestions on this topic which should be of interest to you, send them to Ottoabasi.Abasiekong at Proshare.co, displayed on the screen, that email. And also follow us on our social media platforms displayed on the screen for you. You can log on to our website, www.proshare.co, where we give you rich articles covering the economy and all these discussions on inflation, various reports. You have them all captured if you log on to our website. So do that after this. And don't forget that you just have to continue to engage Proshare for very incisive information. Thank you for being part of the show today. Till we come your way again, thank you for watching and have a lovely day.